Hello, welcome to Accounting Hub. I'm Professor George Scarpin, PhD in accounting, and today our topic is about job order costing, and we will work with cost flows. Here, we will sort of combine managerial or cost accounting and financial accounting. So, if we think about a manufacturing company, we have product costs and period costs. If you have problems about this kind of classification, we have a video about that in our channel, and the video is in our video description. So the product costs, we have three basic ones: raw material, direct labor, and manufacturing overhead. And period costs, the selling and administrative expenses. And if we combine it to financial accounting, the period costs, we call it the operating expenses, the selling and administrative expenses. And the product cost, it is our cost of goods sold. However, before they are sold, we need to produce them. So when we are producing them, they are inventory. And we have three inventories: raw material inventory, only for raw material purchase. So here, usually it is direct materials, but we can have some indirect materials here as well. And we grab some products from these raw material inventory, and we start working on that. So it is work in process inventory, where we combine raw materials, use it in production, direct labor, and manufacturing overhead. And then we have the cost of goods manufactured. That is the cost that the product that we already finished. And we go to finished goods inventory. And here it looks like a merchandise company. Is our finished good inventory. When we sell it, they are cost of goods sold. So how they work? So let's go to our Excel file, and it will be easier. Okay, let me put some zoom here. Okay, and we will be good. So let me go down here, my screen. You will not be looking at me now. So we have two ways to do that. The first one is using tables. So one table for raw materials, one table for work in process, and one table for finished goods. Or the T accounts. We will be working with the T accounts too. But first of all, tables. So let's consider here Skyping Corporation has provided the following data concerning last month manufacturing operations. Okay, and here, if I do that, okay, okay, now we have more space here. Purchase of raw materials, indirect materials used in production, direct labor, manufacturing overhead, under applied overhead. Wow, when we compare with it with our actual costs, we figure out that our estimate numbers were under applied. So how do we start it? We start with our inventories, beginning inventory. So beginning raw material inventory, 80,000 to $12,000. Work in process, beginning inventory, 56, and finished good, 35. And we are working here with periodic system. And remember, periodic system, we work with the cost of goods sold formula. Big, let me put it here. Beginning inventory plus purchase or production less ending inventory. And if we find this formula for everyone, we will be good. So let's start with the raw materials. Beginning inventory, 12. Purchase of raw materials, 30. Equal total raw materials available. So equal sum So sorry, guys. Equal sum 30 plus 12, 42. Less ending inventory. So our ending inventory here, 18. Equal raw materials used in production. So 42 plus 18. However, we also have indirect materials. So, and we want to know only the direct materials used. So less indirect materials $5,000. So equal 24 less 5, 19. So how do we do that using the T account method? Raw materials inventory, we are talking about assets. So debit increases asset, credit decreases asset. So here, raw materials inventory, $12,000. Purchase increasing, so debit, 30,000. We don't have these subtotals here. So less ending inventory. So if we finish it here, uh, so instead of typing it so bad, 12, 30. Ending inventory, 18. Less indirect materials, so less indirect materials, 5. And what about direct materials used in production? It is the number to balance this journal entry here. So we insert our formula. Beginning inventory plus purchase less ending inventory less indirect materials. So the number to balance is $19,000. So we credit raw materials and we debit work in process inventory. Why? Because we are moving these direct materials from raw materials to working process. Okay, so debit working process credit raw materials. So direct materials used in production, 19. Direct labor, 58. Manufacturing overhead, 87. And these $5,000 here of the indirect materials, they are in the 87. So $87,000. Equal total manufacturing costs added to production. So added to this beginning work in process inventory. So sum here. Well, and let's work with our T account for now. Work in process inventory, beginning inventory here. Direct labor here. These raw materials inventory or these indirect materials used in production, it also goes to our work in process. And here, this 19, it is the yellow one. So the manufacturing overhead will be 87 less 5. So it will be 82. And how much and the total manufacturing cost to account for is the sum of beginning balance plus manufacturing cost added to production. So 220. Less ending work in process inventory. Work in process inventory ending 65. So here is our ending inventory. And what is the number to balance this journal entry here? That is the cost of good manufactured. So it's the sum of all of these guys here less ending inventory. The only number to balance it is 155. So 155 is our green one. Let's double check if it's here. 220 less 65, 155. So we are good. Let's move myself here. Finished good. Finished good is exactly the formula of cost of goods sold. So beginning inventory plus cost of goods manufactured. And if we go to our T account, beginning inventory plus work in process inventory. So the journal entry here is debit finished goods inventory, credit working process. Because we are moving cost of cost of goods completed from work in process inventory to finished goods. Equal cost of goods available for sale, sum of it, less ending inventory 42. So ending inventory 42. So here, let's draw our line here, 42. It would be our cost of goods sold if we have no under or over applied overhead. So here, 190 less 42. However, we have some under applied overhead. And here we have a problem. So, okay, let's do it again here. So here, the 42. And here, 190 less 42. We have the under applied overhead. Our actual number is greater than our estimated number. So we need to increase our estimate numbers. $4,000. So it is a debit in finished goods inventory. Less over applied overhead. Spelling here, overhead. We have nothing, so no over, so nothing. So nothing here on credits. Adjusted cost of goods sold, 148 plus 4 less nothing, 152. Double check here. Equal sum. Our debits less our ending inventory less our over applied. 152, 152 here. So we are some gray here. We are good. But this is accounting and pure accounting. If we show it to our managers, probably they will not figure out what we are doing. So we work with schedules. Schedules for them is easier. However, this schedule is quite small. Schedule for cost of goods manufactured, schedule for cost of goods sold. But we have our numbers, so we don't need to put it here, put all of numbers here again. Beginning work in process inventory, where is it? It is here, 56. Direct materials, let's start it. Beginning raw materials inventory. Beginning raw materials inventory, 12. Plus purchase of raw materials. Purchase of raw materials, 30. Equal total raw materials available. Our sum here. Less ending raw materials. Ending raw materials here, 18. Raw materials used in production, 24. Less indirect materials. Indirect materials, 5. Direct materials, 19. Direct materials, 19. And let's move it. Direct labor plus direct labor. Direct labor, 58. Plus manufacturing overhead, 87. Cost added to production, 164. Much better now. 164. Total manufacturing cost to account for the sum of everyone here, 220. 220. Less ending inventory, 55. Here, cost of goods manufacturing less, oh, total manufacturing cost less ending work in process. So cost of goods manufactured. And the cost of goods manufactured is here. How much the beginning inventory? Beginning inventory, 35. Plus cost of good manufactured, the sum of both. Less ending finished good inventory, 42. You have now unadjusted cost of goods sold, 148. And guys, I was forgetting it. This Excel file, it is in our video description. It is free to download it. And if you also have questions about under or over applied costs, we have a video and it is also in our video description. So plus under applied for less over applied, nothing. Adjusted cost of goods sold, 148 plus 4 less nothing, 152. The same 152 here. Guys, this is schedule for our managers. It is easier for them to look at them. So we have both. We have cost flow for accounting, schedule for managers. Okay, guys, so thank you so much. Subscribe our channel. You will be the first one to know when a new video arrives. Like our Facebook page, Accounting Hub by Dr. Scarping. If you have questions or comments, leave it here or email me at jscarping@gmail.com. And like this video, guys. Okay? Have a very nice day and God bless you.